today's last Targets in Focus of the week, where we discuss some of the most traded currency pairs, I am joined by Chris Turner, Head of FX Strategy at ING in London. Hello Chris, it's great to speak to you. The euro-dollar fell to two-year fresh lows on Thursday. The slide came as Spanish and Italian bonds versus Bund spreads widened. Now Chris, I understand you're expecting the cable to fall yet further over the coming months. Why is this?
Yeah, sure. So basically we're looking for euro-dollar to trend down to 115 by the end of this year. I suppose the key factors driving that are sort of much weaker growth in the Eurozone than, say, in the States. I mean, the States will be looking at growth between 1.5% and 2%. In the Eurozone, we're currently forecasting a contraction of about 1.4%. We've already seen the ECB cut rates to 75 basis points on their policy rate and cut the deposit rate to zero. And I think that's important, that latter point, because the cut in the deposit rate to zero, the deposit rate acts as a floor for overnight interest rates. So since that move, we've now seen overnight interest rates in the Eurozone drop from around 35 basis points down to about 13 basis points today. So Euro overnight interest rates are really on par with those in America, closing in on those in Japan, and it's really offering the kind of Euro up as a funding currency. In terms of big macro picture as well, I mean, the key issue regarding the Eurozone sovereign debt crisis and the problems for peripheral Europe is one of lost competitiveness of Southern Europe over a 10-year period. And I think it's important that if these economies are to rebalance, if it is a balance of payments crisis that would normally require a weaker currency to fix, we think some Euro weakness can really help that adjustment process. Otherwise, that adjustment has to focus on what's called an internal devaluation, which generally means kind of lower wages. So if the euro can fall, it actually makes the internal adjustment somewhat less and slightly easier to deliver. So overall, we think maybe the environment may change as well. I mean, the first half of the year we've seen the euro under pressure, risk off, sovereign debt stress. But the second half of the year, I think we might settle into what's called an orderly euro decline, kind of welcome in most parts of the world, given that, I think most people appreciate that we've seen a sort of a credit crunch in Europe and the Eurozone needs to adjust. So I'd like to think it can be seen in a more benign environment and euro-funded carry trades proved quite popular into year-end.
The yen rose after Bank of Japan kept rates between 0 and 0.1% and offered up no major policy moves. What are your projections for it against the US dollar in the short, mid and long term?
Yes, for dollar yen we're looking for it to stabilise around the 79 to 80 level over the short term and probably move up towards 82, maybe perhaps as 85 by the end of the year. Primarily this is a function, we think, of a weaker yen coming through. There could potentially be a slightly firmer dollar environment in the next 2 to 3 months as maybe lower gasoline prices might help activity. But our big call, I think, is on the yen side of the equation here. The big trade-off we hope to see is that because politicians have decided finally to address the longer-term questions over debt sustainability, last month in June, the Japanese Parliament passed the consumption tax hike, which takes the consumption tax in 2 stages from 5 to 10% by the end of 2015. Because fiscal consolidation is coming through on the political side, we think the pressure will build on the Bank of Japan to support that with easier monetary policy. So at the moment they target their own version of quantitative easing in terms of an asset purchase program where they're currently on target to buy about 70 trillion yen worth of assets. We think they could increase that by the end of this year and generate a weaker yen. There are some slight risks in that the one factor that has been keeping the yen strong seems to have been foreign demand for Japanese money market instruments. Last year, foreigners bought about $200 billion worth of Japanese money market instruments. Perhaps that might be some global FX reserve managers, maybe Asian FX reserve managers diversifying from the dollar and the euro into yen. If that keeps up, perhaps that would mean our targets up at 85 don't get hit after all.
And finally, the Norwegian krona sharply depreciated against the euro this week after inflation figures in Norway came in softer than expected. However, am I right in saying that you maintain a bullish outlook on this currency pair?
Yes, we think, the NOK is generally has stayed quite strong. The Scandinavian currencies this year have performed well, primarily because they've got low debt ratios, generally around sort of 40% of GDP. I think in general that we won't necessarily see the Norwegian crown too much firmer. In the past, there have been problems when the Norwegian crown has strengthened too much and triggered a bout of deflation, and certainly Norges Bank was aware of that in the early part of last decade. So were the Norwegian crown to strengthen too much, we think it may accelerate maybe some earlier rate cuts from the Norges Bank. Overall, however, and probably the balance of risk probably still favour actually a lower euro Norway. If you look at what's called output gaps, if activities were to surprise on the upside, which central bank might actually tighten rates first? Well, it looks like, according to the IMF, that Norway will run what's called a positive output gap in 2013, the economy operating above capacity, and were the global economy to surprise on the upside, actually Norges Bank could move first to hike.
Chris, it has been a pleasure. That's all we have time for at the moment. Click back to Dukascopy for a look at the week ahead with my colleague Thomas Taplin, but for now, goodbye.